Welcome to our March 2017 Economic Update. A couple of quick announcements before we get started. Thank you very much for your participation with the CTN vote. We got the result that we wanted. Those 3 directors have been removed and the 2 directors have been elected to the board. So we expect director fees to be cut, and over time we expect the independent ratings of buy on CTN will happen. The second announcement you would have seen yesterday, Suncorp Metway have announced their next fixed interest note, and we'll have more information about that to you soon. Getting straight into it, the energy crisis. I can't help but be very disappointed by what I've read in the newspapers. And why do I say that? A client actually phoned me a couple of weeks ago and pointed out that between 2011 and 2013, I had already stated that the country would be running short on gas and that electricity prices would be continually rising, maybe up to 3 to 4 times what we were seeing back in 2011 to 2014. Why? We had just approved very large LNG gas plants up in northern Queensland. This would suck a huge amount of gas out of Australia's gas network, and prices were always set to rise. So when I read in the newspapers that large customers are very disappointed because the prices of gas are now up to 6 times what it was back in 2011, 2012, those large customers had plenty of time to find smaller companies that were developing oil and gas reserves and develop those and get a long-term supply for themselves. In fact, we even invested at the time in a group, Westside. Westside had 3 takeover offers, and some of us were able to take advantage of that 3 times in a very positive way and make very good profits. The government has not had great leadership here. Carbon taxes, the renewables agenda, constantly switching in between policies, constant switching in between parties has made this a very uncertain sector. Investors, bank lending, everyone has been so nervous to commit capital to this sector. Thus, we have found ourselves in a current state of affairs that is terrible. And I'll tell you what's really terrible about it. Australia collectively has the largest assets in coal, gas, uranium, and sunshine in the world. We should have the cheapest energy in the world, and you can see that these electricity prices have just shot up through the roof. So I find this is very disappointing. We have made good money out of groups like Westside in the past. There's a couple of other gas development opportunities that we are looking at, but they are not for the faint-hearted. You'll see in your notes, and the energy sector starts on page 4, that the Westside share price was very volatile throughout this period. There are much more larger, stable, well-heeled companies like Woodside that is now paying a 9% grossed up dividend yield. The other thing that we'd warn against is with this large run-up in energy pricing, electricity pricing and gas pricing, a few of the utility groups, their share prices have soared. We would now be very uncertain about this. We think the market is pricing out 10 years of high pricing. That will not happen. Gas and electricity prices will come down as solutions are found, and we would be very wary about any investments in these companies. Moving on, our next major points are about rising US interest rates. This starts in your notes at page 9. We have been harping on about this for some time, and certainly the interest rate rise announcement we got this March from the US Federal Reserve is the 3rd in a series of 12 hikes that Janet Yellen has been saying will take the US through to a neutral rate or level of interest rates. Why is it neutral? At that 3% level, she has said, the US economy is neither being stimulated nor is it been slowing down. So it's very important to understand that the GFC came around. You can see in that left-hand chart there, the US interest rates, in the red line falling straight down. There were 21.25% interest rate cuts in the US. And you can actually see in the red line of the chart that's on the right, Australia also had 21.25% interest rate cuts. Now, the US economy, as we've been saying, is well ahead of the Australian economy. It is at a period of interest rate rises, and we will follow that. But we don't currently see any interest rate rises happening in the Australian market in 2017. Our economic recovery is well behind. We expect that our interest rate rises will probably start in 2018. Neutral interest rates for the US, 3%, 3 rate hikes down, 12 to go. So we've already mentioned at about 3 or 4 economic updates now the reasons why the US will hike. But I'll just go over that quickly with this chart again. You can see the policies of the US in bringing down their unemployment have been amazingly good. They've done an excellent job. It's now come under the natural rate of unemployment, which is the green line, and it's heading down to the minimum rate of unemployment, which is the black line. Why are these lines so important? Once you go underneath the natural rate of unemployment, job participants become scarce. If you want good, educated labour, then you need to poach those people from other people. So you need to offer them 10% more, or 10% more with a car, or 10% more with a car and a free mobile phone. So wages inflation starts to rise quickly, and that leads into general underlying core inflation rising quickly in any given economy. And one of the main mandates of every central bank is stable pricing, which is defined at a price rising level, and a little bit of inflation is very good, a price rising level of 2%. So to keep on that 2% target, they move interest rates, sometimes to speed the economy up, sometimes to slow it down. Once you drop below that natural rate, they want it to slow down. Every time that unemployment has gone around that minimum level, it's left the Fed behind the curve. That means it has to hike those interest rates really quickly to keep up with inflation, and that has always led to a US recession. So that is why it's so important that the US start to raise interest rates now. They have scheduled 3 for this year, 3 for next year, and 4 for the year after. And that just gets us to a neutral level. What are the consequences of these rising interest rates? Okay, rising interest rates means bond yields over time will rise. Why is that so important? Bond yields are a very good indicator of where the future interest rate levels are going to go, and it's also meant to compensate you for inflation and some growth in the economy as well. The black lines on these 2 charts actually represent where Donald Trump was elected. So I just wanted to show you the explosion in bond yields coming from the Trump election. The other point why bond yields are so important, not only are they indicators of future interest rate rises, but the 10-year government bond represents the world's risk-free rate. Why is that? Because a government has 10 years to tax its populace to pay back any money that it needs to. So it's always seen as being risk-free, because the base that you can tax is not only every business in your economy and every individual in your economy, but you can tax alcohol, cigarettes, estates, whatever you want, property taxes. So it makes the payment back of government debt risk-free, especially at the 10-year level. So in the charts you can see the other thing I wanted to demonstrate is in the top chart, which is US bond yields, the 2-year in the blue, the 5-year in the red, and the 10-year in the brown. Now, The 2 and 5 years have been jumping up quite markedly, well over 100%, and the 10-year hasn't gone up as much. The US still has its quantitative easing program in place. It's not allocating new monies to it, but any of the bond interest coming from its huge bond portfolio that it owns, it is still using to buy 10-year bonds to suppress those long-term rates. So that brown line is still being artificially suppressed at this point. That program will stop. And when it does, that 10-year bond rate will increase even further. And that's our risk-free rate. And why is that so important? If we are going to invest money outside something that is risk-free, we expect to get a return for that. And that return has to be more than that risk-free rate. There are many investments out there, such as infrastructure, healthcare, utilities, and property trusts that have benefited as the long-term bond rate has come down. As that risk-free rate has come down, the yield offered by these sectors have looked more and more attractive, and the prices of the assets in those sectors have risen quite dramatically. As bond yields turn around and head back up, what was once positive, so positive for those sectors, over long periods of time, 7 years, 10 years, in some circumstances 20 years, will change and turn around. So the most important thing about rising bond yields is our strategies involving the sectors that we are going to be exposed to are going to change, and we're going to have a different focus. I want to touch briefly now on the telco sector and what has happened. You can see here the red line represents what the total sum of telco investments have done over the last couple of years. And you can see that red line has fallen away. The telco sector is one of those sectors that have always had a stable and slightly growing yield, and it has definitely benefited as bond yields have fallen down. So part of the pullback is due to that. But we did get our specialist telco analyst, Nick Harris, to come in and talk last night about what's happening further in the telco sector. Now, this is interesting. I would call this the second stage effect now of NBN. So NBN has been rolled out to over more than 25% of the population now, and every telco out there has become a reseller of NBN for the data services. NBN is more expensive. Jumping up from ADSL has gone from a cost of $13 a month to about $43 a month. So some of those telcos are struggling, passing on those increased charges to the consumer. The other thing to compete in this space, new telcos have been coming in offering NBN at no margin. They are offering NBN at cost. And it has really cut back margins in the sector. And you can see relative to what the ASX 200 line has done, which is the blue line, the telco sector has really fallen down. So Telstra, out of the major companies, have probably held up the best, but we have to remember it has fallen from about $6 to about $4.50 as we've moved through this time. Its margins have been hurt, just like everybody else. The saving grace for Telstra is that the government is actually paying Telstra compensation for all the new clients that it moves across to NBN. Every time someone moves across to NBN, Telstra gets a $1,300 payment. It also gets compensated for using the copper wire ducts that Telstra had rolling the NBN cables through there. So Telstra will continue to receive compensation for many years yet. But for the margins that they are losing, it is not adequate compensation. Telstra needs to build a new business. It needs to find new lines of earnings coming through in the future. The market is doubting at the moment that those new lines of business can be made. Our telco analyst, Nick, who came on to present last night pointed out to other opportunities out there like Superloop. Superloop has rolled out its own dark fibre cable in Hong Kong, Singapore, and here in Australia. And by a recent acquisition of Big Air Group, it now has the wireless technology to make that last jump from where the cable runs in the major streets into consumers' homes or business homes. Superloop will be focused early on, mainly on business premises only. We do think it is a good investment, but it is at very early stages. This will be the first year that Superloop will start paying its dividend. Part of the quandary for us is when do we start moving some investment monies from the secure dividend payer of Telstra across to Superloop. Nick also spoke about NextDC, which is one of the large Australian data centre groups, as having very attractive fundamentals for capital growth and dividend as well. Moving on, now this is the next most important point after the rising of US interest rates, and that's what we're doing with you in fixed interest. At the moment, please appreciate we are holding very high cash balances, and they will be like that for the next couple of months. There are nothing less than 8 new notes coming out, which are going to have more attractive margins than some of the other notes that we have sold. So, with the new notes that are coming, they are going to pay us higher dividends on average each year by about 1%. So they're definitely worth waiting for. The other thing is, these new notes, because they are higher margin, are going to trade at higher prices than what those other lower margin notes would have. Indeed, with a large amount of new notes coming on, what we're going to see is that the price of those lower margin notes will start to fall, and as the new notes come on, their prices will start to lift in the current market. There are 2 effects that I haven't explained before that I'll just go quickly through about why that happens. And the example is sitting behind me and actually starts around page 58 to page 60 in the notes that you have. And it's what I call the margin effect, and it's very simple. Would you like, if it was all the same risk and the same institution, a 5% distribution, a 5.7% distribution, or a 6.4% distribution on an annual basis? And if there's no catch, there's no hitch, you'll say, I'll have the 6.4% one, please. And that is the margin effect. There are 3 notes from Westpac as we speak. You can see those here. The Westpac PEs is paying 5% annualised distribution grossed up. The Westpac PF notes are paying the 5.7 and the Westpac PGs are paying 6.4. So if we wait and take the higher margin notes, we are going to get higher distributions each and every year that we hold those notes for. The second thing you need to know, the Westpac PE notes are trading at $98. That's the one that pays 5%. The Westpac PFs are trading at $102. That's the one that pays 5.7. And the Westpac PG are the ones trading at $105. And they're the ones that pay 6.4. So the margin effect is the higher margin notes that pay the greater annualised dividends trade at higher prices. And that's what we're waiting for. We have recommended that you sell the Westpac PE notes. I believe as the new notes come on, the Westpac PE notes will trade down, and the new notes coming on with the higher margins than the Westpac PE notes will trade up. So that is the margin effect. So don't forget, we've sold those lower margin notes. We're trying to avoid capital losses as those notes trade down in price. We're getting the higher margin notes that will trade up in price as people will keep buying them for those higher distributions. The other effect, and something that I've never covered before, is the actual volume effect of new notes coming onto the market. This is a little bit more of a difficult concept to grasp, but it's all about the law of supply and demand. You put a lot of volume of new notes down in the market and all the price of all the notes will go down. If you have a period of time in the market where no new notes are coming out, then all the asset allocators and financial planners and superannuation funds of the world are constantly buying fixed interest. They have to buy the old notes that are sitting out there, and the prices of those notes will start to rise. 2016 was actually a period of very low new issuance in the market, and we were buying some of those older notes in the market and they did extraordinarily well, and I'll show a few graphs of that very soon. 2014, you can see in the chart behind me, which is the tallest line, was a period of huge new margin issuance, and the prices of the notes currently sitting out there were pushed down quite a lot, and I'll show that too in the slides ahead. So, in a period of small to no new issuance, we have a different strategy of buying some of the older notes that are out there. In a period of sort of medium new issuance of notes, some of that buying volume is satisfied by the new volume coming onto the market. So particularly we want to focus on the high margin notes because they will always be supported, and move our money from the low margin notes to the higher margin notes. Once again, higher distributions, and it's going to trade at better prices. In a period of intensively high new issuance, then we need to be more agile in moving from our lower notes to our higher notes, because the new issuance will attract all the money, so all notes will drop. The low margin notes will keep falling as people sell them for the new notes coming on, and the higher margin notes will eventually be supported and move back up to the high prices again. To be very clear, 2017 is going to be a year of a large volume of new notes coming on, and that's why we've sold the lower margin notes and we're waiting for the new issuance to come out. We have only settled for one note, and that is the CBA note, and that will not list till the 31st of March. The second note that came on was a challenger note. Morgan's was not the lead manager. Any allocations we got were ridiculously small, but we are thinking of buying some challenger on the market when it lists in the first week or two of April, if we feel the price is attractive. The third note, which got announced just yesterday, was Suncorp. We think that is an attractive note. Morgan's is a joint lead. The allocations will be good. We think there are another 5 to 6 notes coming. So in the interests of diversification, we want to spread our risk across as many notes as we can. So there are another at least 3, 4, maybe 5 or 6 notes coming your way. By the time we leave late May or late June, we will have you all in high margin notes paying the highest annual distributions possible, and they should trade at the best prices given their margins are so attractive, people will keep buying them. Just a quick demonstration of the effect of a large amount of new notes being issued. The two top graphs that you can see there were the issuance of the CBA PD note back in 2014 and the Macquarie Bank PA note that was also October 2014. At the same time, there was a challenger note being issued and there was a Bendigo Bank being issued. What actually happened, you'll see in those two bottom graphs, you see those big drops that happen as we move through August and September and in early October. People are selling down those notes and making way for the new notes to come into the market. I could have example of 6 to 7 other notes. The drops were very large. The largest one I saw was about 8%. Probably the shallowest drop in note price was about 4%. So we are definitely doing the right thing on the capital basis having some monies ready to go into the new notes when they come. Now, just in these 4 graphs in front of you, now we've only settled for one note, as I said, the CBA note, and already you can see in those lower margin notes, they are starting to weaken off. So the CBA note isn't even listed yet. So a lot of the selling of these older notes to move to these higher margin notes hasn't even yet begun, but some of them have fallen 1.5% to 2% already. So this effect, as the next 8 notes come in, will become more stark. But don't worry, you've already prepared for that. And whenever I talk about rising US rates feeding into rising Australian interest rates, that is excellent for your fixed interest notes, because that will be recognised in your distributions as soon as the interest rate rises happen in Australia. So you're in a very good position. Moving forward, just to quickly review what global indices have done over the last 12 months. Up until the Trump election in November, the Japan, America, Australia, it was all looking pretty flat. Since the election of Donald Trump, we have seen a shift up in all bourses across the world, except for China. China is the grey line. They haven't been particularly ecstatic about the Trump election. The bourse that's benefited the most in the green line there, you can see standing near me, that's Germany. The EU is really kicking along and going great guns. Everyone that was worried about the British exit being bad for the EU economy or bad for the British economy is going very well. And the FTSE 100 in Britain is almost as high as that German green index is looking. The S&P 500 in the red has been performing very well, and the Australian bourse and Japanese bourse has also done fairly well over this period. Funnily enough, in the jumps that we've seen in the Australian market, a lot of those monies went back to those utilities, which once again we're warning against. We think those electricity prices will fall. We're not looking at putting money into utilities at the moment. We also feel a little bit of money has come back into the property trust sector, a little bit of money has come back into the infrastructure sector. I want you to think of the price movements in these different sectors like the tide and waves. When the tide is coming in, the waves wash in, push prices up, they have a retreat. The next wave that comes in, if the tide is coming up, will push those prices higher and they will retreat, and the next wave will push them higher again. The tide, we feel, is going out for property trusts, for infrastructure, for those sorts of stocks. So already we've seen a pullback in prices. The tide, the next wave is coming in and pushing those prices up slightly. They won't get to the previous peaks and they will pull back and go down further. Then the next wave will come in, will lift them up a bit, then they will pull back and go down further. So we have already prepared for rising bond yields, but in the short term, over the last 3 months, it has affected some of our performance. We will be running a little bit behind because the rise in utilities has been quite large, and the small bounce back in infrastructure and in utilities and property trusts, we aren't there in a particularly large way at all. We are looking at cyclical growth coming through, and I'll show you that on the last couple of slides before we leave. The next thing I just wanted to quickly look at is we've been a big backer of the smaller cap companies. Since the election of Donald Trump, just over the last 4 months, the blue line, which is the large cap businesses, they have outperformed. On a 15-month basis, the smaller caps, which is the green lines and the brown lines, are still the outperformers. The mid caps, which is the red line, is doing very well. But I just wanted to point out in the Australian market, it's the large caps that have benefited the most since the election of Donald Trump. This has not been the effect in the States. In the States, which is the next graph underneath, I do the S&P 500, their top 500 stocks. versus the Russell 2000 index, which is their small cap indice. And you can see the small cap indice in the red line has well outperformed the blue line. So a little bit unusual here in Australia at the moment, but we are seeing a small correction coming back in the pricing of those smaller businesses. But we believe in the future we'll go back to looking like the Russell 2000 index below, where the smaller cap businesses will continue to be favoured over large businesses. I just threw in this, as you know, I'm not licensed to talk about the property market. There's been a lot of news and information. The property sector starts on page 30 in your notes, and I've copied several articles from newspapers and other sources for you to have a read and make your own judgment. The only thing I will note is, as we've moved through this period of falling interest rates, and I've sort of graphed there since about 1995, the interest rates have fallen from 11.5% down to around the current, I'm just taking a guess at mortgage rates, at about 4.25%. So 11% is about a 250% increase in interest rates to get you from 4.25 to about 11.5. Over the same period of time, property prices have risen about 250%. I just want people to be aware that as we move into the next interest rate hike cycle, that is, as we move away from emergency crisis lows in interest rates, I think it will put pressure on those property prices. I don't think you will see the same returns over the same period of time. And there are articles there that you can read and make those decisions for yourself. I wanted to point out we've been a massive fan of what Trump is trying to do for shares. And a lot of the positivity that you've seen in American and in European shares has come, number one, from economic circumstances already being good and getting better before Trump was elected. So the earnings of businesses have been rising quite sharply, quite positively, and we're seeing the share market move ahead with that. But Trump is also promising tax cuts for the consumer, tax cuts for the business. That makes shares more valuable. That gives businesses more money to spend and grow. That gives the consumer more money to spend, which pushes economic growth. These things are very positive. The markets are waiting for Trump to get this legislation through Congress and through the Senate. There has been a setback recently where the repeal of Obamacare didn't go through, and the market has started to question, will Trump get these other packages through, the tax cuts, the infrastructure spending, the defence and military spending that he wants to do. These pieces of legislation will be hotly debated in Congress and will be hotly debated in the Senate. And we feel that as they're debated and get pushed back and negotiated on, you will see volatility in the US share market. You will see corrections in the prices of US shares. We think the US share market has run well ahead of itself. As these problems come up in Congress and the Senate, you will see share prices fall down, but we think they will rise again. We think that the next 2 or 3 years will be incredibly positive for share markets. We would expect to be seeing capital gains coming from share markets. The US economic discussion, you can see there the point I made earlier about US earnings per share rising. It's coming up to record highs. So it's very good. We expect that to keep going. That's very good for shares, but we think in the short term it's run ahead. Watch for regulation being delayed. Watch for corrections coming in to the US share market. What is good for the US and what is good for the EU has been that the purchasing manufacturing indices coming out of the EU and the US have been positive. They've been the highest they've been for 6 years. The news coming out of China is very positive. The other thing that China is doing in this latest 5-year plan is closing polluting industries and cutting them back and closing inefficient mines. The closing of inefficient mines is very good for Australian commodities because they'll go into seaborne trade to make that volume up. The closing of polluting or trying to limit pollution in China is very good because you can do that by using higher quality materials, which once again favours the Australian resources sector. This is the 5-year plan for China. They will keep focusing on this as we move through the next half a decade. We think that's very good for our commodity cycle. Just touching on oil, a little bit of a recent dip before we come into that period of seasonal strength. You'll see those red circles on the graph. When we get through from about to April through to that June period, we tend to see a seasonal rise in the oil price. It's been a very cold winter. It limits economic activity. As we move through into the summer, you get the summer holiday season and driving period. Economic activity picks up. All the mines that have been snowed out, they all pick up, and you see a rise in the oil price. We still feel that this seasonal rise has yet to happen. We're very positive on energy prices. I promised that we'd talk about the economic cycle and how it is shifting. You'll see that little dot is right on the cusp now of moving from a defensive position, moving from those utilities, property trusts, into the cyclical growth sector. That's going to be resources and material stocks, that's going to be energy stocks, that's going to be industrial stocks. So we are right on that cusp now. There's going to be volatility between some of those bond proxy conservative sectors and volatility in the cyclical sectors. So we are moving through that change now. Expect that volatility, but don't forget we feel the rising cyclical sectors now are the rising tide, and we feel those bond proxy sectors now are in a falling tide. Just touching on our core portfolios before we close up. So you'll see two of our key listed investment companies, the BKI that have all the Australian blue chips in it, the Contango, the CTN that we've just voted upon for you. These other graphs here include the 25% rise we've seen in QBE. That was all from the rise in bond yields, and we think that will keep going. QBE in the core portfolio. You can see BHP sitting up there in the top right-hand corner. We're also moving to include Challenger Financial. It's the graph just below BHP. And we've got Westpac Bank sitting in there. Two that we have before the committee at the moment that we're looking at is the Woodside I spoke of before with the 9% yield, and with the good performance of the UK economy, and with Clydesdale Bank having 120% of its current loan book backed by deposits in the UK. As we move through into that 2018-2019 financial year, we have Clydesdale Bank returning a 13% dividend. So we're looking at this with our model portfolio committees right now. Our key market themes, you can see behind me, haven't changed. There's more reading on those sectors for you. It begins at about page 66 in your notes. Thank you very much for your time. We really appreciate that you're making about 35, 40 minutes available every 3 months just to learn what our strategies and focuses are. There's always more detail in the notes for you, and we'll see you again in 3 months' time in June. Thank you.